Hi, this is Ronnie Garibian from Garibian Real Estate and Finance. I'm sure you've been hearing so many confused news and information out there in regards to what's happening with the mortgage rates. Why is it going up? Why didn't the Federal Reserve drop the rates, or is going to drop the rate more? You've been hearing about the tariff, what President Trump is doing, how is that going to affect inflation, is going to go back up, we're going to have a recession, and so many confusing news out there. Well, I don't blame you guys. In a short few minutes, I'm trying to catch up and tell you guys what's happening here. Of course, there's always the unknown in the future. Nobody has a crystal ball. Nobody knows what the future brings us. But in the 34 years in the mortgage industry and real estate industry, I have learned so much, especially following up our details economy on daily basis for the last 34 years. We heard just recently our Federal Reserve Chair Jerome Powell in front of House Financial Service Committee did say that we had a great progress in recession where we were and where we came. But not enough, he said. It's not enough because it seems like we're just not quite there yet. They want that 2% inflation, which I personally think, I doubt we're going to have the 2%. We're somewhere in the high twos. But of course, the CPI came out the other day at 3%, which was much higher than expected. And that pushed the 10-year Treasury up. And that 10-year Treasury obviously indirectly affects the mortgage rates. So how does the mortgage rates work? The mortgage rates, historically speaking, they're tied to the 10-year Treasury bond. The 10-year Treasury about 4.6% today after the CPI news came out. And usually about 1.5 to 1 3/4 is the spread or the margin that the banks have on top of the Treasury. So at 4.6, you had 1.5, you're about 6.1 to 6.5%. That should be today's rate. Is that a bad rate or a good rate? Well, that all depends who is it for. But I can tell you what it is. It's supposed to be 6.8 to 6.5%. That's the right rate according to today's economy, according to today's 10-year Treasury bond. But recently, the banks have that extra 1/2 to 3/4 cushion on top of the regular 1.5 and 1 3/4, and that's their safety just in case if we're going to get into any inflation. That margin, that extra cushion they have, will go away, but when? Most probably will go away when there's a little bit of a certainty in the economy, which I don't think we're going to have certainty in the economy ever. The reason we're not going to have it ever, because there is always something. We're globalized now. It is not local. It is not only what happens in the United States, it's what happens globally. Whether it's the wars, whether it's the COVID, whether it's something else. So we're never going to have that steady, comfortable, peace of mind economy that everyone expects to have. Those days are gone. So on a daily basis, news will change. On a daily basis, the demand will change. But there is, of course, a trend. Like right now, we're in sixes. Why are we in sixes? Again, because according to all the data, according to all the Federal Reserve and CPIs and everybody else, economy is doing good. If economy is doing good, that means people are making money. That's why the rates are higher, to make sure the inflation doesn't get expensive. What happens is when you make money, when people have jobs, as you heard the job creation we had last Friday, job creation is there. Granted, is not over the top, is not heating up, which is a good thing. But once jobs are there, and people are making money, and economy is good, and stock market is doing good, so what happens is if they drop the rate, it's going to get really expensive because cheap money or free money like we had during the COVID days, that's one of the reasons we are where we are, because the rates were so low, the money was so cheap, so people took advantage of it and everything became so expensive. Now at sixes, because we're following the 10-year Treasury, because the 10-year Treasury is based on the future forecast of the economy, and it's saying we're doing good, so there's no reason for the rates to go down. Do you want the rates to go down? That's a different story. It depends who you're asking. But I will recommend if the rates go down, that means we're going to have unemployment, because that's what the feds are waiting for. They want to see if there's more layoffs. They want to see if there's less jobs created. Once they see those dangers, once they see those effects that come in the market, then they'll start dropping the rates. But guess what? You could be one of those individuals who be laid off, who don't have a job. So what? The rates will be lower if you don't have income, if you don't have a job, if people are laying off, if you're not sure if you're going to have your job 6 months from now. So what's going to happen is you want to make sure the economy is good. Once it's good, so what? You pay the rate. I always say it anecdotally to my friends, you rather make $1,000 a month and spend $800, or you rather make zero money and have nothing to spend. So at the same time, that's what we see in the market. Market is hot. Economy is good. Granted, the local this is nationwide. Some states, some cities will have some effects of some kind of another. Some are seasonal businesses. Some are economic effect businesses. But overall, as a country, the economy is good. People have jobs. There's no layoffs. Yeah, we heard Meta is laying off 3,500, but they don't say they're laying off 3,500 in a specific department. But at the same time, they're hiring maybe 10,000 new employees on their AI department, which is completely new. So are the rates high? Yes, they're high. High compared to what? Compared to the 2.5%, 3% that we've been spoiled with during the COVID. But if you take the COVID out and go back before 2019, rates were in the 5 to 4% rate. So it's not too far off from our average we always had. Before COVID, did it stop anyone to buy home? No. But what happened is during the COVID, when the prices of the real estate went up at least 50% in most of the places, that's the problem we're having. It's not the rate as much, it's the valuation of the properties. Would the values go down? That also I'm having problem to see is going to go down. Why? Common sense, 5th grade, supply and demand. There has to be more homes for more individuals who want to buy a home. We have more populations, we have double generations, the millennials, the Gen Zs are coming up and so on. And a lot of people, of course, life is longer, they live longer, the baby boomers do not move anymore. They used to move, downsize, move to more areas that is better community for seniors. But with today's technology, with the Instagrams, with the Ubers, with lifestyle that is changed in over last 10, 15 years, there's no need for our seniors to move as well to a specific community because they can communicate now much easier with social media and with technologies that we have. So the reason that's why they're not moving as well. So overall, a lot has changed. Rates are in 6s, are going to stay and remain in 6s for the remaining of the year. When it comes to tariffs or President Trump tariffs, what's going to happen? It's a different video. I'll tell you guys about it some other time. But for now, this is it. Don't expect the rates to be in 5s or 4s anytime, at least next 2-3 years. We don't expect it to go down there. And if it does go down there, it could be a costly drop. Maybe the economy is not doing good. As far as the Federal Reserve Chair is concerned, their rate, that rate has nothing to do with mortgage rate. It helps with student loans, with car loans, with line of credits and HELOCs and credit card loans, but does not affect the mortgage rates directly. That's just a benchmark rate that one bank borrows from another bank overnight. So Federal Reserve dropping it is not the issue. Is the comments and the statements the Federal Reserve makes. That's the part that is important to the economy. So overall, this is it. You want more information, give me a call. I'll give you more details specifically that is designed for your individual case. But stay tuned. I'll give you guys more video in regards to tariffs, what I think of those. Nothing to panic about. I'll catch you guys later. Take care.